The bond vigilantes, could they strike after Trump's inauguration and push yields even higher? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. We've received quite a few messages like this one on Friday. Jennifer, I've been hearing a lot about bond vigilantes and the role they may have in keeping the new administration's policies in check. Can you please do a video to explain what that means? Well, for Mary and all of you who've asked, this is that video. Here are the 3 topics that we'll be covering in today's update video. 1. Who are the bond vigilantes? What do they do? And how might they impact your treasuries? 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the yield expectations for the upcoming week's treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Who are the bond vigilantes? What do they do? And how might they impact your treasuries? As Oxford Languages defines it, a vigilante is a member of a self-appointed group of citizens who undertake law enforcement in their community without legal authority, typically because the legal agencies are thought to be inadequate. Think neighborhood watch with aggressive policing. When a famous economist, Ed Yardeni, coined the term bond vigilante back in the 1980s, he meant a similar phenomenon in the bond market. When institutional investors and bond traders lose trust in the ability of a government to keep its finances in order, they will, at some point, take the law into their own hands, so to speak, and stop buying the bonds. Here's how the thinking goes on this. So when institutional investors and bond traders stop buying government bonds, this buyer strike forces the government to raise the coupon on its bonds so that it can find at least some willing buyers. But the higher coupons means that borrowing is even more expensive for the government. This, in turn, makes bond investors and traders even more skeptical that they will be repaid on time and in full. And the result is that the government will be pushed to offer even higher coupons to sell their bonds, and so on and so on. Basically, these institutional investors and bond traders who stop buying government bonds and start this buyer strike, they are the bond vigilantes. And if this cycle goes on for too long, it can cause, in the worst case, a real crisis in the financial markets. Possible government reactions to break the cycle include cutting expenses and or raising taxes to stabilize the budget and eliminate the deficit. Now, such crises have happened in the past, and they can have good and bad endings. In a famous example from recent U.S. history, when Bill Clinton took office in 1993, he was subject to an attack by the bond vigilantes, and the budget deficit was only 3.7% of GDP at the time, compared to 6.6% for 2024. So Clinton reacted by raising taxes and cutting expenses, and in this way became the last president we've had to show a budget surplus. So, while a balanced budget and the ensuing economic growth in the 1990s certainly counts as a positive outcome for our bond aficionados here at NestEgg, the bond vigilantes can also show an uglier face. When Liz Truss, the former British Prime Minister, and Kwasi Kwarteng, her finance minister, announced a package of tax cuts that were not balanced by government savings in the fall of 2022, the bond vigilantes sprung into action again. This time, the ending was really not pretty. British government bonds had their worst day in history, meaning their prices crashed and their yields spiked, almost destabilizing the financial system of the country, and the British pound sank to record lows. As a result, both Truss and Kwarteng had to resign shortly thereafter, making Truss the shortest-serving prime minister in British history. So what should we expect? Will there be a potential battle between the bond vigilantes and the incoming Trump administration? As always here at NestEgg, let's look at the facts first. The U.S. ran a budget deficit of 6.6% for 2024, and that is not sustainable in the long run, as we've discussed regularly here in our NestEgg community. Our $36 trillion of government debt from all our deficits since former President Clinton's days in office means that the U.S. is very vulnerable to increases in the interest that it's obligated to pay on its treasuries. And while the Fed has been cutting short-term rates, rates on the long end have been on the up and up since Election Day last year. This table gives you a snapshot of this rise in longer-dated yields since Election Day 2024. Here's where yields stood at the close of the market on Friday, and here's where yields stood on November 5th, 2024. As you can see, everything from 2-year through 30-year has gone up, and in some cases, significantly, meaning that the government has been paying more and more interest on its longer-dated treasuries since Election Day. Higher interest on a still growing amount of debt means that net interest expense was the fourth largest expense in the federal budget in 2024. So these factors, a high budget deficit, a large debt burden, and rising rates on long-term treasuries, this means that the U.S. is indeed, in principle, vulnerable to an attack by the bond vigilantes. If they feel that the incoming Trump administration's policies will significantly increase the budget deficit and subsequently the U.S. debt burden, institutional investors and bond traders could, in theory, become bond vigilantes again and kick off this buyer strike here and start pushing Treasury yields higher until the government changes its policies to bring down the deficit here as well as the ensuing debt burden here. That said, the U.S. does have 3 strengths in its favor that other countries don't necessarily have, which may keep the bond vigilantes from implementing a full-on buyer strike. First, the dollar remains the globally dominant reserve currency, meaning there's usually a certain level of demand for U.S. treasuries that can support the market for a while. Second, the U.S. economy has better growth prospects than most other developed markets, and maybe even more so than some emerging and developing nations as well. And third, the Treasury and the Federal Reserve are seen as the global gold standard in terms of crisis management and have ample experience with interventions to stabilize financial markets. Only time will tell how this will all end, but from Monday, which isn't far away at all, the ball will be firmly in the court of the new Trump administration, and the entire world will be watching Trump's next moves on critical issues such as tariffs, immigration, taxation, and government spending versus saving. And it looks like he and his team already have a full-on agenda for day one. According to the Wall Street Journal, Trump has already prepared roughly 100 executive orders. And as usual, we'll keep watching the space for you here at Diamond NestEgg so that you can be among the first to know when the first decisions are taken and when we might be able to discuss some possible money moves with our community. Don't do anything rash in the meantime. With that in mind, let's move on now to the next section of today's video. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's Daily Treasury Par Yield Curve Rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Treasuries across nearly all maturities ended the week lower than the previous week for 2 main reasons. First, core CPIU and the Producer Price Index, which measures wholesale prices, came in lower than the market expected. And second, Fed Governor Christopher Waller went on record that he was more optimistic than his Fed counterparts about inflation coming down, and that 3 or 4 rate cuts this year might be a possibility if the data supported it. As a point of reference, most of the market was anticipating 2 rate cuts coming into the new year. No surprise then that yields ended mostly down for the week, including the 20-year, which was not able to hold on to its above 5% yield from the previous week. The 1-month and the 6-month were up by only 1 basis point, and the 2-month was once again unchanged. Our Diamond NestEgg regulars know that at this point in the video, we typically compare Treasury yields from this past Friday to the beginning of the year. But since it is the beginning of the year still, we'll do things with a slight twist for January. Let's take a look at Treasury yields from this past Friday versus the same day 1 year ago in 2024. This row shows where rates ended this past Friday. This row shows where rates were on January 17, 2024. And this row shows the increase or decrease in rates over the past year. Again, increases in rates are shown in black and decreases in rates are shown in red. Treasury yields across all maturities 3-year and up are noticeably higher than where they were a year ago, with the biggest differences to be seen on the very long end here. After last week, the yield on the 2-year is now lower than where it was a year ago, as are all these other maturities, with the biggest differences to be seen on the 1 to 6 month T-bills, which is to be expected given that the Fed lowered rates on the short end quite a bit last year. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. Do note the unusual auction date for the 13-week and 26-week. It will be on Tuesday, as all major markets are closed on Monday for Martin Luther King Jr. Day. The 52-week T-bill and this 33-day CMB are also on the schedule. And if we scroll down further, we can see the 19-year, 10-month T-bond and the 10-year TIPS will be auctioned off as well this upcoming week. The 19-year, 10-month T-bond is a reopening auction, so we already know what the coupon will be on this. At the time of this taping, here's what the coupon and the expected yield are for the 19-year, 10-month T-bond on Fidelity's platform. And here's what the coupon and the expected yield are for the 10-year TIPS. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries for this week. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one from Federal Home Loan Banks at 6.25%, with a first call date in April 2025. Here's the CUSIP for those of you who may be interested. For corporate bonds, the list is still fairly long on Fidelity. Here's where the highest yielding new issues stand at the moment, with the highest yielding one from Deutsche Bank at 6.20%, with a first call date in January 2026. Here's the CUSIP for those of you who may be interested. For brokered CDs, the highest yielding one is from CFG Community Bank at 4.75%, with a first call date in April 2025. If you know of any bank CDs or high-yield savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to build a source of stable, predictable income in retirement, especially while bond yields are still quite attractive, then check out this video here on our beginner and intermediate level bond courses, which we are in the process of updating. Use coupon code BONDS2025 to get an additional 10% off of our popular bond course bundle before the end of January. The 10% coupon code BONDS2025 can also be used to purchase Bond Beginners or our intermediate level course Bond Masters individually. And as a reminder, our next Bond Beginners live course session is this weekend, Sunday, January 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into the upcoming week's 20-year T-bond and 10-year TIPS auctions. And our next YouTube member live will be the following Sunday, January 26th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 2, 5, and 7-year Treasury auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.